Hi, Eric Schoenfeld here with TechCrunch TV. I'm with Duncan Davidson, who's a managing partner at Bullpen Capital, and we're here in TechCrunch Tokyo. Thank you for joining us.
Konnichiwa.
Konnichiwa. So you gave a very interesting presentation.
Thank you.
Where you explained sort of why venture capital is being disrupted today. What's your view on what's disrupting venture capital?
It's being disrupted both at the early stages and the late stages. Let's talk about early. Back in the 90s, you'd do a seed round and then you'd have a Series A, which would be 4 or 5 million. And everybody understood that model. What's happening now in the era of cheap, you don't need 4 or 5 million. So after the incubation stage, the average money going in these deals is around $800,000 from the so-called super angel funds. The round after that only needs 2 to 3 million. Bullpen's role is to do that round. So we let somebody else do the $800K million round. We then do the $2 to $3 million round, and we participate with others in it. It's too small for the Series A firms. Some of the smaller funds will play at $2 million, but you go to most of these Series A guys and they say, you don't understand, we have $800 million in our fund. We don't do $2 million. We do 5, we do 6. It's more money than these companies need. So the funds, super angels, are coming to us to help them fund that 2 to 3 million round. And then if the company validates, we sort of go right underneath the Series A to the next stage and raise 15 or 20. I call that a shovel-in round. So that's the disruption at the beginning of the cycle.
So we heard about the lean startup model where startups start lean and they get to product without that too much money.
Yeah.
What you're talking about is the lean finance model. Can you explain that?
We're in the era of cheap, so you can get away with doing this. The whole concept is keep the money as lean as possible until the company validates as a real market, a real opportunity, and begins scaling. Then you shovel the money in.
And what's the difference between the lean finance model and the fat finance model?
Well, the fat model, the funds have a lot of money. I used to be in a fund that had $4.5 billion under management. It's hard for them to place less than 5 million. It just doesn't move the needle. So they need to put more money in play. So the fat model really came from their needs to try to invest in big wins and grow big wins. It worked fine in the 90s. It doesn't work now. These companies cannot spend that 5 million. They don't know what to do with it. So the funds are not sized properly for the new market. The new venture funds that are doing the lean model are much smaller. I mean, some are 140 million, some are 200, but they're not billion-dollar funds. They're not $800 million funds.
And are you expecting the returns will be similarly smaller as well?
We think what's going to happen, if you focus on IRR, you embrace a much quicker flip. You embrace secondary selling through second market. You don't try to hold this thing for 8 to 10 years to see if you can get a billion-dollar outcome. You don't do it that way. You try to turn the money much more quickly. When you look at the return model to the LPs, much better. They don't want to be in these funds 10 or 12 years. It's way too long. Money's losing venture because it's too slow an asset class. By turning it faster, the return on capital is very attractive. The IRRs, in effect, are actually higher than they'd be in the other model.
So a few years from now, what do you think the impact of all this will be on traditional venture capital firms?
Well, we're already seeing it. 80% of the money going to venture in the last year went to 7 firms. I think you guys reported that number. Great reporting. So you're already seeing a great bifurcation. The branded big funds are getting stronger, Sequoia, Kleiner, Excel, etc. And then this new breed of fund at the bottom are getting stronger. Best data I've seen is half of all institutional first money in for internet deals. So half of the money is coming from the new breed of super angels. It's tremendous disruption. So, but in the middle, the funds in the middle are in deep trouble. They don't have the brand or the capital raising power of the big funds, and they're not getting the great deal flow these new super angels are getting.
So do they disappear?
Yes.
And the big funds, the Accels and Sequoias of the world, they still get the pick of the litter?
Well, they're moving a little later in the food chain. They're also playing early, but they're really moving later. They're letting this whole experimentation, the Cambrian explosion, as you put it, of little cheap deals, just work their way through and filter down to the ones that are starting to scale, and then they lead the shovel-in round. If you look at the 3 great deals that Kleiner did a couple years ago, Zynga, NG Mocha, Chegg, they really came in the shovel-in round after these companies began scaling. They were not the first money in, first institutional money. But they've performed tremendously for them. It was a smart strategy.
So they were in the Series A or the Series B?
Well, I don't know what the letter is. Probably C.
Probably C. Okay.
I think with Zynga there was an A, then an A1, then Kleiner came into what was named a B, but it was really the 3rd institutional round.
Do you expect to see a Series A crunch?
Yes and no. I mean, there's a lot of story on that. What's happening is some of the lean companies are basically going underneath the Series A and bypassing it. So technically, you don't see a lot of Series A money going in, but these companies are still getting funded more in the bullpen round, followed by the shovel-in round. So the crunch is less than the data would say it is.
I see. Okay. Well, thank you so much for sharing this with me.
Eric's been great. Thank you.